Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with investment manager Nick Hyatt to talk about what clients should consider when they're looking at investing in VCTs. So Nick, someone approaching VCTs for the first time, where do they start? How do they begin?
So I think VCTs can be quite intimidating, especially if you're new to the whole sector. But I think there are probably 5 things to consider when you're starting out that can really help. The first is whether a VCT is actually right for you. Now, there's quite a lot behind that, and we can come back to it in a moment if you like. But once you've established that you are keen to invest in a VCT, then there are 4 further things I think you should consider. The first is the manager. What's its resources like? How many staff does it employ? Does it have the team you need to manage it successfully? The second is the investment strategy. So what kinds of companies is this VCT going to back? How old, how small? What kind of sector are they in? Thirdly, whether the VCT has a great track record of performance. Has it actually executed that strategy successfully in the past? And finally, what does the portfolio look like today? That's the portfolio you're going to get on day one. And the great thing about VCTs is you can look at it on day one. So go and do that too.
Just going back to your first point, how does someone know that a VCT in the first place is right for them?
Well, VCTs are a bit like an investment trust, except that unlike an investment trust, you're investing in small, usually private companies. That makes them riskier inherently. You've got small companies might have great successes, but they might also be really struggling. They might really struggle for years. Some will fail altogether. As an investor, you need to accept that those risks exist. Now, that means that VCTs are often more appropriate for people who have larger tax bills or who are higher earners. And the reason for that is because VCTs have some very, very attractive tax breaks that go with them. Partly to encourage people to invest in smaller companies, but also to offset the significant risks that go with that. So you're entitled to a 30% income tax break if you invest in a VCT, as well as tax-free dividends and tax-free capital gains. Now, one of the things you should bear in mind is that because these are riskier investments, you're likely to be a more experienced investor by the time you consider them, with a more established portfolio of diversified, more mainstream investments, and you're probably only going to put in maybe 10% of your net wealth into this kind of thing on day one. Now, the great news is that as well as having very attractive tax benefits, there's also a very generous allowance on offer with VCTs. You can put up to £200,000 a year into VCTs and still receive the tax benefits, but obviously both the investment decision and also the tax benefits will depend on your personal circumstances.
So there's about 15 to 20 different VCTs open at any one time. How do you choose which to go into?
So I think the first thing to consider is the manager. Now, the thing about VCTs and how they're different to a more mainstream equity fund, say a fund investing in FTSE 100 companies, is that when you're managing a fund investing in FTSE 100 companies, you only need to look at 100 companies and you can invest in them at any time, any one of them. Now, that's just not the case with VCTs. With VCTs investing obviously small private companies, of which there are millions, and a manager might well look at hundreds or even thousands a year. So you need a manager that has got the expertise, the team, to be able to do that successfully. And the other thing is that whereas a FTSE 100 fund manager can invest in any of them at any time, and all FTSE 100 managers have the same opportunity set, with a VCT, not everyone has the same deals. You can only invest in a company when it's fundraising. Often that process is quite secretive, and the company itself has a say in who they sell shares to. So you need a manager that has the reputation to be able to attract the best entrepreneurs.
So how does the manager actually go about making themselves attractive to entrepreneurs?
So I think one of the big things is focusing on a particular strategy, whether that's looking at, say, a particular sector of the market. It might be healthcare companies, it might be B2B software businesses, or maybe a particular region of the UK. So there are VCTs out there that focus particularly on northern or maybe even Scottish businesses. What that does is it limits the number of companies that a VCT manager has to look at. It only has to look at a particular sector. And it also gives the manager greater scope to develop really relevant expertise. So it doesn't have to be a generalist in all things, it can specialise in particular parts of the market. Now that really appeals if you're an entrepreneur. You're probably, if you're running a cloud computing business, more likely to approach a VCT that specialises in cloud computing and understands you when you're talking to them about your business and understands the challenges that your business is likely to face, much more than a generalist who really only has a passing knowledge of what your business does.
And how important should past performance be when assessing which VCTs to choose?
So it is one of the first things that people look at, and it is important. But the thing about VCTs is that VCT returns rely on outliers. It's those small companies that go on to become billion-pound companies that really generate all the return. And in that kind of investment process, there's always an element of luck. If you look purely at performance, there's a risk that you end up selecting a manager who's been lucky rather than good. And actually, we think that it's good managers that deliver repeatable performance. So instead, when we're looking at performance, which we do as part of our featuring process, we're looking for managers that have delivered great returns, but by doing the same thing again and again and again, things that they can repeat in future. If you're a healthcare specialist, we want you to have generated your returns from healthcare investments.
So Nick, a lot of people buy VCTs because of the dividends and they can pay really chunky dividends. But how important is that when you're actually assessing whether this is a good VCT or not to invest in?
So dividends are absolutely crucial because one of the great things about VCTs is that they pay tax-free dividends. You can't just look at a share price when looking at VCT performance because that will miss all of those dividends that have been paid out over the years. So absolutely, dividends are key. We look at total return, which includes dividends when we assess VCT, and we publish total return for all the VCTs listed on our website, so you can go and look at them too. But the other thing is that dividends are paid out of exits. When a VCT sells a company, it receives cash back, and that is what funds dividends. So we also want VCTs to have a clear track record of exits in the past. Now, the great thing about exits, they also show that the VCT manager is a good manager and it values the existing investments appropriately. So when a VCT sells a company, we want its exit price to be similar or ideally above the price at which it's held in the book. Now that's really important to you as an investor because it's that price that's held in the book that you're buying it at when you buy VCT shares. So those exits and validation of those exits by third parties are really, really crucial.
You know, I couldn't agree more. What about other factors?
So as I said at the beginning, one of the great things about VCTs is that you can see the whole portfolio or a very large chunk of the portfolio before you invest. Now that might be great because you spot a name in there that you are familiar with and you think is very successful or has the potential to be very successful. But even more important than that, it gives you an idea of how diverse the portfolio is on day one. Especially if you're starting out in VCT investment, you probably want to invest in a VCT that has a large portfolio, so you're not putting all your eggs in one basket. Now, the great news is there are VCTs out there, people like Octopus Titan, the Maven VCTs, that have a portfolio of more than 100. So they're very diverse on day one, but plenty have more than 50 in their portfolio. Over a couple of years, buying a couple of VCTs each year, you can build yourself a very diversified portfolio quite easily and quite quickly.
Yeah, of course, that's very important.
So Alex, I'm sure everyone's dying to know, how do you invest in VCTs?
Sure, well, when I actually first started investing in VCTs, that was about 11 years ago. And at that time, there wasn't really much information about VCTs available. And so I didn't really know a huge amount about them. I actually started investing because of pension changes, I couldn't put any more in a pension for the first time. So what I knew about VCTs was two things. They were very tax efficient, and that's what I wanted. And two, I knew they were very risky. In fact, I thought they were a lot more risky than they actually turned out to be because my VCT investments have done very well over the whole. Whereas when I went into them, I really thought maybe I'll get a bit of tax relief, but quite a lot of these are going to fail. But because of the risk and the known risk, what I did was diversify. So I invested my first batch of VCTs in about 5 or 6 different offers. And I think what's also really important for anyone going into this for the first time, first of all, choose an experienced manager. The older managers are better, one, because they have experience, but two, because they're going to have a much bigger portfolio, which by its nature is going to be more diversified, and it's going to have older, more established companies in it to counterbalance the more risky younger companies that it also has to invest in. So I think that's very important. When you get someone like me who's been investing for a long time in VCTs, suddenly actually I have a lot of exposure to these older style VCTs, so it's probably time for me to start looking at newer VCTs. These are riskier, they don't have nearly as many companies in, they're also much younger companies in, and so for someone like me, it's a bit of a risk, but on the flip side, I'm getting new companies, new managers, and if something actually does well in one of those VCTs, because they're still small, that performance actually could feed out to some very good returns for me.
Yeah, it sounds like you really appreciate one of the things I think is most important about VCTs, which is that you get that diversification to begin early on in a VCT. You get lots of companies, and if you sew together lots of different VCT investments, you get quite a nicely diversified venture portfolio quite quickly, and obviously say all with those great tax breaks too.
That's true. And I think the other very important thing to note about it, when I actually took out these VCTs, I wasn't expecting all this tax-free income. And over the years, typically your VCTs are churning out 5 or 6%. Of course, it's not guaranteed, but it's a very welcome tonic.
So that all sounds great, but you've been doing this for 11 years. Are you still investing in VCTs?
Yes, Nick, where funds permit, I nearly always invest in VCTs each year. And I think for a lot of people like me, it makes a lot of sense. Once you've done your pension and ISA, it's a really good thing to do. And it's hugely tax efficient, and there's a huge allowance of up to £200,000 a year. So thanks, Nick. That's a great discussion. Before we wrap up, perhaps you could just summarise in 1 or 2 sentences what investors should be looking for.
Of course. So I think the key takeaway is that VCTs can make great tax-efficient investments, albeit higher risk. And in order to help mitigate that risk, one of the things you should look for is to diversify. That could be across different managers, across different investment strategies, across different ages, as you mentioned earlier, and also across different years. So that helps to mitigate that risk of being individually exposed to small companies, and helps you to make the most out of your VCT investments. And obviously, if you want to find out any more, then go to wealthclub.co.uk and you can read reviews on pretty much the whole VCT market.
Thank you very much.